So a crazy day in the market today. Today's January 20th, 2016. And I just want to walk through what I think went on and some of these support and resistance levels that I talked about last week. What you see here in the red, these are the support levels, meaning as the market is going down, will it break through a support level? Or if the market is going up, can it break through a resistance level? I mentioned the important nature of 1990, that as we moved up from the difficult week we had the first week of 2016, that if we hit 1990 and ricocheted off that with a high fractal dimension, that's the key here. That's the main thing, which we did not see today. I'm going to touch on this in the end. But hit 1990 and ricochet off with a high fractal dimension, that could open us up to this 1520 down below. So there's a lot of validity to the support and resistance levels. If we just look at how the year started, January 4th, the market closed down and sat right at 2012, right above this support level. Then January 15th, it went up a little bit to 2016. And then January 6th, it closed right down on this resistance level. January 7th, the market went down and went to 1943. And then down to the support level, it closed on January 8th at 1922. So it sat right on top there. We had the weekend. We come back on January 11th, and the market basically moved sideways to 1923. So it stayed just above this support level. Then January 12th, we go up to 1938. Then January 13th, we close at 1890. And then on January 14th, we go back up and we close right at this level, the 1920. And then January 15th, we close down and sit right on top of this level. Yesterday, the 19th, we basically moved sideways to 1881. And then though the markets were off significantly today, I mean, the Dow was off well over 400 and ended up closing down about 250. The NASDAQ was down almost 150 at one point today, and it barely closed down today. It closed at -5, and that's mainly because of a bunch of biotech stocks really rallied in the NASDAQ. The S&P was down over 50 during the day, and it ended up closing down 22 at this 1860 level. Now, the perspective I wanted to communicate in this video is this is what was lacking today, which is why I think we saw the market actually come back and not have this big cratering down to this 1520. If you recall in my update last week, it was if the market came up to this 1990 resistance level here and ricocheted off with a full fractal dimension, then that was look out below at 1520. We don't have a high fractal dimension, and honestly, the way the market closed today, this looks like it could be some kind of consolidation for a move back up. So what I would look at is what this move does, and this is still the important resistance level, 1990. If we get there and move through and move up, then it brings in these higher markets at 2520. If we do see a ricochet with a fully loaded fractal dimension, then that 1520 is in play here. Do I see a risk of this happening? You bet. I mean, between the China, oil, U.S. earnings reports that are now starting to come out, how oil is affecting not only just the U.S. frackers, but now we're hearing more and more about the Canadian oil producers as well. And then ultimately, just confidence, right? But there's something lingering out there that is really bothering me. And it first started bothering me when I saw in the Democratic debates, Hillary Clinton and even Bernie Sanders talking about this notion of forgiving college debt. And when they said that, I thought, well, that's interesting. Are they just throwing a bone to their constituency? But then I realized if we've learned anything from politicians, and that is nothing is said by accident. So I started thinking, well, how in the world would they do that? And I started reading a book over this 3-day weekend, about halfway through it. And the book is by Adair Turner. Now, he's the UK Financial Services Authority. He was put in that right 1 week after the financial collapse in 2008. So the UK Financial Services Authority, that's kind of like our SEC. More importantly, this guy is a right-hand man of George Soros. So as I'm reading the book and trying to understand his argument about what he wants to do to prevent another 2008, because that's clearly what is on everyone's mind when you see all these people meeting in Davos, Switzerland, all these wizards of wonder trying to figure out all these incredible things about what we're going to do and the central governments and the monetary policy. You read this and it just put a chill down my spine, and let's just read it together. It seems that we are out of ammunition, meaning all this quantitative easing and the low interest rates just pumping money into the system, what the central banks have been doing in order to try to create inflation. The policy magazine is empty, but if the problem we face is inadequate nominal demand, meaning inflation, the magazine is never empty, and there is always one more option left. That option is fiat money creation, using central bank printed money either to finance increased public deficits or to write off existing public debt. There it is, right there. That is writing off $1.3 trillion of student loans. And just so you can see the title of his book is Between Debt and the Devil, Money, Credit, and Fixing Global Finance. What he's basically suggesting is a repeat of what Roosevelt did coming out of the Great Depression, and that is giving Congress a bunch more money and having them stimulate the economy by pumping it in the system through creating all these jobs of building roads and airports and fixing this and fixing that. And that's what he means by finance increased public deficits, right? Doing it that way, sending the money through Congress. Instead, what they've been doing is they've just been giving money to the banking system through the Federal Reserve and selling bonds, but the banks aren't doing anything with it. They're just sitting on it, right? So you have $19 trillion in our system that's not moving around. And so people like Adair Turner are thinking, well, you know what? The banks aren't doing their job. We need to take matters in our own hands. And this is his solution. So I'm going to finish the book, finish the analysis, and I'll actually write the January alert on this. But this was very disturbing to me. And if this happens, folks, right, if you think about it, well, what could prevent the market from going into another 2008 if the central bank wants to step in? Well, what they could do is just simply follow this pattern and take quantitative easing times 10. And then we are in real problems, right? We're in real problems in two capacities. Number one, we have more debt than anybody can define. And number two, once you get inflation going, you can't throttle it back. And we will go into a hyperinflation that makes the 1970s look like a cakewalk. Anyway, let me end the video here. I hope this was helpful going through the support and resistance levels. And I appreciate you being patient with my little intellectual exercise with this book excerpt. Thanks for watching.